The Fed said the plan is to keep an eye on the economic trends, make changes if needed to support job growth and control inflation, which is still above the Fed's 2% target. Ted Thatcher, president of Brightwood Lake Wealth Management, joins me now. Good to have you, Ted. So what led to this cut, and do you agree with it?
Great question. I think, the Fed wanted to keep on trend with the statements that they have said in the past. Jerome Powell cited a number of times that they really did want to cut this year. Now, I do think we've got a whole lot more word salad to deal with coming out of this meeting. They revised their projections for 2025 down, of course, citing economic data that they're seeing, certainly the sticky inflation above their target, like you noted. They're not seeing the movement upwards, at least far enough in terms of the unemployment rate. And I think that's ultimately what's driving this decision.
Okay, so high inflation and, everyday prices, they were key factors in voters choosing Trump. How will this rate cut affect affordability, do you think, in the coming months?
It's a great question. I think it depends on what category we're looking at in terms of affordability. I think really interestingly, while, of course, the Fed lowered today, the federal funds rate, when they lower it, most closely correlates with like a money market account, really short-term, debt assets. Now, if you look a little deeper, though, the 10-year Treasury actually spiked up. And so when you speak to affordability, what that says is long-term rates are actually higher as of the middle of the day here today than they were this morning. And so if you're in that, situation where you're trying to buy a house like so many Americans, unfortunately, we just got bad news because the Fed revising their target for the federal funds rate next year to not lower as far actually means there's potential for mortgage rates on a 30-year, home purchase to be higher.
I was just going to ask you about this because the rate cut, it could help lower the costs of some debt, right? Like credit cards and some loans. But the mortgages, like you mentioned, they've actually risen since the election, and high housing costs remain a major concern for many Americans. Do you see anything in sight when these fixed mortgage rates might eventually come down to make buying a home and refinancing more affordable?
I think it really is going to come down to the economic vital signs that we get next year. So basically meaning, is there a case to be made for the Fed to actually lower at a more aggressive pace than they cited today? So interestingly, when you see a really strong economic vital signs that say the consumer is strong, it really makes a hard case for the Fed to look at that and say, hey, we're willing to lower. Why? It's because of that sticky inflation that we've talked about. Now, if we do see, maybe coming out of the holiday season and in Q1 of next year, signs of a weakening consumer, maybe we look at those retail sales numbers that we often will look as an economic vital sign and say, oh, those aren't as strong. Maybe consumer sentiment's not as strong. Maybe the unemployment rate starts to tick up higher and higher. Interestingly, there's a dichotomy there where those type of more, I'll say, negative economic vitals actually give the Fed air cover from a data standpoint to lower faster. And that's, I think, ultimately where we would actually see the relief for someone looking to buy a home at a lower rate.
Okay. Ted Thatcher, president of Bright Lake Wealth Management. Thank you for your insight today. If I don't see you before the holidays, Merry Christmas. Happy New Year.
Merry Christmas.
Thank you.